Welcome to the Pirls Stock Market Commentary video featuring the proprietary bull-bear point and figure market breadth summary chart for December 4th, 2016. Market breadth. With this past week's market decline, our bull-bear point and figure ratio at 1.30 fell from 1.73 last week, remaining within bullish territory. The total count of securities in bullish or bearish patterns decreased 1% to 3,134. The count of bearish stocks increased 17%, while the count of stocks in bullish patterns decreased 12%. The Pirls PNF market breadth summary chart shows us a market now 4 weeks in bullish territory. Paid subscribers have access to the OpenOffice Calc data from which the chart is generated. You may become a paid subscriber by visiting s2pmarketsignal.com, clicking Membership, clicking Register, and following the prompts. To receive the Pirls Stock Market Commentary via email, free of charge, simply enter your email address in the space provided and click Subscribe. The well-known market breadth indicator, the Nasdaq McClellan Summation Index, rose 67 points for the fifth advance in 16 weeks. At a positive 156.44 points, it continues below all 5 tops above plus 100 and continues above all 6 bottoms below minus 100 in the last 3 years. Volume analysis. In this week's volume analysis, the Nasdaq Composite Index ended in neither accumulation nor distribution mode, with average daily volume higher than the prior week. In the last 2 weeks, the Nasdaq had 2 accumulation days and 3 distribution days. Accumulation days are counted when the index closes up on higher volume than the prior market day, while distribution days occur when the index closes down on volume higher than the prior market day. Last week, the Nasdaq ended in neither accumulation nor distribution mode on lower average daily volume. Momentum, now at a negative 21.24, down from a positive 128.66 a week ago. The CCI 20 daily continues with 2 days below zero in a Woody's uptrend and is now inside the plus or minus 50 range for a valid zero-line reject long entry signal. In Woody's CCI trading system, 6 consecutive bars above or below zero are required for a change of trend. The weekly CCI 20 of the Nasdaq Composite Index began a Woody's uptrend 31 weeks ago, while the daily CCI 20 began a Woody's uptrend 2 weeks ago. The CCI 20 weekly has fallen to 92.9 from a positive 178.79 last week, dropping below plus 10, thereby exiting the Woody's zero-line reject long entry signal begun at Friday 11/11 close. We will report the results of this trade simulation in next week's commentary. Industry rotation the last 2 weeks. All of the top 5 industries are positive, and all of the bottom 5 are negative. Summary: oil, oil services, and gold and silver on top. Some tech on the bottom. Bullish, REITs has left the bottom 5. Bearish, oil services continues in the top 5. Oil has entered the top 5. Comp tech continues in the bottom 5. Disk drives, semis, comp tech, and comp hardware have entered the bottom 5. Brokers and semis have left the top 5. Gold and silver has left the bottom 5 and entered the top 5. Focus this week from www.zerohedge.com. Did the market just flash A Hindenburg Omen Warning by Tyler Durden. The following are some key points and charts. With major indices diverging notably, new highs and new lows soaring, and breadth deteriorating, analysts noted the reawakening of the Hindenburg Omen signal. And this week saw renowned technician Tom McClellan declare a Hindenburg Omen had struck. As we discussed over 6 years ago, the dreaded Hindenburg Omen is easily the most feared technical pattern in all of chartism for the bullishly inclined. Those who know what it is tend to have an atavistic reaction to its mere mention. Those who do not can catch up on its implications courtesy of Wikipedia. But in a nutshell, the Hindenburg Omen is a technical analysis that attempts to predict a forthcoming stock market crash. Granted, the Hindenburg Omen is not a guarantee of a crash, and the 5 criteria that must be met for a Hindenburg trigger typically need to reoccur within 36 days for reconfirmation. Yet, the statistics are startling. Quote, looking back at historical data, the probability of a move greater than 5% to the downside after a confirmed Hindenburg Omen was 77% and usually takes place within the next 40 days. End quote. As a reminder, the 5 criteria of the Omen are as follows. 1. That the daily number of NYSE new 52-week highs and the daily number of new 52-week lows must both be greater than 2.2% of total NYSE issues traded that day. 2. That the smaller of these numbers is greater than or equal to 69. This is not a rule, but more like a checksum. The condition is a function of the 2.2% of the total issues. 3. That the NYSE 10-week moving average is rising. 4. That the McClellan oscillator is negative on that same day. 5. That new 52-week highs cannot be more than twice the new 52-week lows. However, it is fine for new 52-week lows to be more than double new 52-week highs. This condition is absolutely mandatory. The last Hindenburg Omen occurred as the markets began to roll over in June 2015 and did not end well. However, while McClellan called the Hindenburg, it appears it may have fallen just short. Checking the rules? Yes. See chart above, red and green lines both above the blue. Number 2, yes, 74 is greater than 69. Number 3, yes, 10,628 to 10,631, rising. 4, yes, McClellan oscillator, negative 5.85. Number 5, no. 236 new highs is more than double the 74 new lows. And so, from the most strict definition, the Hindenburg Omen did not strike this week. But it's close. And as a reminder, while no Hindenburg flashed, Dana Lyons noted both the number of new highs and new lows set 3-month highs just over a week ago. If that sounds odd, it is. In fact, it was only the second day ever in which each set a 3-month high. And since 1970, only 18 prior days saw new highs and new lows set as much as a 1-month high. What causes the elevated numbers of new highs and new lows? And why would it necessarily be a negative for the stock market? We're not sure, and we don't really care. We're never too concerned with the whys when it comes to the markets. All we care about is what is happening. And for whatever reason, the market has been especially weak, and consistently so, following the occurrence of lots of new highs and lows. That is a legitimate red flag currently, in our view. Thank you for viewing this week's Santu Pirls Stock Market Commentary video featuring the proprietary Bull Bear Point and Figure Market Breadth Summary Chart compiled by Donald Pearl, www.s2pmarketsignal.com. Hoping that you are enjoying a peaceful and pleasant weekend, that you are looking forward to a prosperous and productive week coming up, and wishing you true success.